Hi, everyone, this is the Encyclopedia Channel. Currency is the foundation and medium of modern social and economic activities, running through people's daily life and business transactions. However, for most people, the generation and issuance of currency is a mysterious and complicated process. This program will discuss in depth the way of making money and explain in detail from the four parts of the money generation mechanism, the role of the central bank, money creation, and money circulation. After watching this film, you can have a deep understanding of money nature and mechanism of operation. Part 1. The generating mechanism of currency. Before we look at how modern money is made, let's review the evolution of money. In ancient times, people used barter to trade, which was called commodity economy. With the development of society, people gradually realized that it is more convenient to use a generally accepted medium to exchange goods, so metal currency came into being. Metal currency is a form of currency made of precious metals such as gold, silver, etc., whose value is widely recognized. However, with the development of the economy, metal currency has gradually exposed problems such as high load capacity and inconvenient carrying. As a result, people began to use paper money as a substitute. Paper money was issued by the government or the central bank, and its value and exchange relationship with metal currency were regulated by laws and regulations. With the advancement of science and technology and the development of the economy, electronic money has gradually emerged. Electronic money is a digital record stored electronically in a bank account and can be transacted through electronic payment systems. The rise of electronic money greatly facilitates people's transaction activities, speeds up transactions, and reduces the need for physical cash. Part 2. Central banks and currency issuance. Central banks play an important role in the creation and issuance of money. The central bank is the monetary authority of the country, responsible for formulating and implementing monetary policy, maintaining the stability of the currency and the safety of the financial system. The central bank controls the money supply through a series of operations and measures to maintain stable economic growth. The central bank has the right to issue money, which means it has the power to decide how much new money is introduced into the economy. 2.1 Responsibilities and roles of the central bank. Central banks play a key role in the creation and issuance of money. Its main responsibilities include monetary policy formulation. The central bank is responsible for formulating and implementing monetary policy to control the money supply and interest rate levels in order to achieve the goals of economic stability and inflation control. Currency issuance right. The central bank is the only currency issuing institution which has the right to decide to issue new banknotes and coins, and to determine their value and circulation range. Money supply control. The central bank maintains the stability of the currency and the balanced development of the economy by controlling the money supply. It can control the money supply by carrying out open market operations, adjusting deposit reserve ratios and interest rates. Financial regulation and stability. The central bank is responsible for supervising and managing financial institutions to ensure the stability and healthy development of the financial system. It is also responsible for handling financial crises and risk events to maintain the stability of the financial system. 2.2 The central bank's right to issue currency. As the only currency issuing institution, the central bank has the right to manufacture and issue currency. It can issue new currency by printing banknotes and minting coins. Central banks have their own printing houses and mints that print banknotes and mint coins. Before issuance, the central bank will determine the number of issuances based on economic demand and money supply. Design and issue commemorative coins. The central bank can also design and issue special commemorative coins with commemorative significance to commemorate important national events or figures. Digital currency issuance. With the advancement of digital technology, the central bank can also issue digital currency. Digital currency is a virtual currency that exists electronically in the blockchain network and is issued and supervised by the central bank. 2.3 Monetary policy and influence. The central bank influences the money supply and interest rate level through formulating and implementing monetary policy, thus exerting influence on the economy. The objectives of monetary policy usually include inflation control. By adjusting the money supply and interest rates, central banks aim to control the rate of inflation in order to keep prices stable. When the inflation rate is too high, the central bank can tighten monetary policy, reduce the money supply, and raise interest rates to curb inflationary pressures. Conversely, when the economy faces the threat of deflation, the central bank can adopt loose monetary policy, increase the money supply, and lower interest rates to stimulate economic activity and boost inflation. Economic growth and employment promotion. By regulating the money supply and interest rate levels, central banks can influence economic activity and employment. Lower interest rates can stimulate investment and consumption, promote economic growth and employment. On the contrary, raising interest rates can curb the overheating economy and inflationary pressure, so as to maintain the balance and stability of the economy. Exchange rate stability. The central bank can also maintain the exchange rate stability of the national currency by intervening in the foreign exchange market. When a country's currency is under pressure to depreciate, the central bank can sell its foreign exchange reserves to buy its own currency, boosting the exchange rate. On the contrary, when a country's currency faces appreciation pressure, the central bank can purchase foreign exchange reserves to curb currency appreciation. Part 3. Commercial banking and money creation. In addition to the role of the central bank, commercial banks also play an important role in the creation of money. Commercial banks create money through their deposit and lending activities. 3.1 Deposits and loans. Commercial banks are recipients of deposits and providers of loans. When a person or business deposits funds into a bank account, it is equivalent to lending money to the bank, and the bank records it as a deposit on the customer account. These deposits are regarded as the liabilities of the bank and also become the basis of the bank's deposit and loan. Based on deposits, commercial banks can extend loans to other customers. When a borrower gets a loan, the bank credits the corresponding loan amount to his account. In this way, commercial banks create new money through lending activities and expand the money supply. 3.2 Diffusion effect of multiple deposits. There is a diffusion effect of multiple deposits in the process of creating money in commercial banks. When a person deposits a deposit with a bank, the bank can keep part of the deposit as a reserve, which is used to meet statutory deposit reserve requirements. The remaining deposits can be used to issue loans to other customers. These loans are again deposited into other bank accounts, forming new deposits. And these new deposits can be used again by banks to issue loans, forming a continuous circular process. This multiple deposit diffusion effect enables commercial banks to create more deposits and loans through limited reserves, further expanding the money supply. 3.3 Regulation of money supply. Although commercial banks can create money through deposit and lending activities, the central bank plays an important role in the regulation of money supply. Central banks use monetary policy tools to influence the lending activities of commercial banks in order to control the money supply. The central bank regulates the money supply by changing the reserve requirement ratio. The deposit reserve ratio is the percentage of deposits that commercial banks must keep in accordance with statutory regulations. By adjusting the reserve requirement ratio, the central bank can influence the loanable balance of commercial banks, thereby controlling the creation and supply of money. In addition, central banks influence the money supply through open market operations. Open market operations are the buying and selling of financial assets such as government bonds by central banks. When a central bank buys government bonds, it pumps money into the banking system, increasing banks' reserves and loanable balances, which expands the money supply. Conversely, when the central bank sells government bonds, the banking system has fewer reserves and loanable balances, limiting the money supply. Part 4. Currency circulation and payment system. After the currency is generated and issued, it enters the currency circulation and payment system to realize people's transaction activities. 4.1 Currency circulation methods. There are various currency circulation methods, including cash and non-cash forms. Cash circulation refers to the use of banknotes and coins. People can pay for goods and services with cash. The relatively fast circulation of cash makes it easy for people to carry out small transactions. Non-cash circulation refers to transactions through electronic payments and bank transfers. With the development of electronic technology, people can use credit cards, debit cards, e-wallets, and mobile payments to make payments. These cashless payment methods are convenient and fast, and are suitable for transactions of all sizes, including online shopping, e-commerce, and cross-border payments. 4.2 The role of the payment system. The payment system is the infrastructure of currency circulation, responsible for processing and facilitating various payment transactions. It provides a safe, efficient, and reliable payment channel to transfer money from the payer to the payee. The payment system consists of the following components. Banking system. Commercial banks and central banks make up the banking system, providing services such as deposits, loans, transfers, and settlements. They process payment transactions between individuals and businesses and ensure that funds are secure and settlements are accurate. Payment institutions. Payment institutions are institutions specialized in payment services, such as third-party payment institutions, payment gateways, and e-wallet providers. They provide electronic payment and online payment solutions to provide people with convenient payment methods. Payment network. The payment network is a communication network connecting various payment institutions and banking systems to ensure fast and secure transmission of payment transactions. Among them, international payment networks such as SWIFT and Visa play an important role in cross-border payments. Payment tools. Payment tools include credit cards, debit cards, prepaid cards, electronic wallets, and mobile payment applications, etc., which are used to realize payment transactions. People can choose the appropriate payment tool to pay according to their own needs. 4.3 Payment security and supervision. With the development of payment technology, payment security and supervision have become particularly important. In order to ensure the security and legality of payment transactions, governments and regulators of various countries have adopted a series of measures. Encryption. Payment transactions typically employ encryption to ensure the confidentiality and integrity of payment information. Through the encryption algorithm, the payment data is encrypted during transmission, and only authorized parties can decrypt and read it. Regulatory framework. Countries have established corresponding payment regulatory frameworks, and regulatory agencies are responsible for supervising the operation of payment systems and payment institutions. They ensure that payment institutions comply with security standards and anti-money laundering requirements, and provide consumer protection measures. Anti-fraud measures. The payment system has adopted various anti-fraud measures, such as real name system, password verification, risk assessment and monitoring system, etc., to prevent fraud and illegal activities in payment transactions. In short, the generation and issuance of currency involves the central bank's monetary policy formulation and currency issuance power. Central banks maintain economic stability and inflation control goals by regulating the money supply and interest rates. Commercial banks create money through deposit and loan activities and expand the money supply through multiple deposit diffusion effects. Currency enters the circulation and payment system, and transactions are realized through cash and non-cash methods. The payment system provides safe, efficient, and reliable payment channels, including banking systems, payment institutions, payment networks, and payment tools. The implementation of payment security and regulatory measures ensures the security and legality of payment transactions. It should be noted that the creation and issuance of currency is a complex and multi-layered process, involving the monetary policy and regulatory measures of the central bank, the deposit and loan activities of commercial banks, and the operation and supervision of the payment system. The effectiveness and stability of these mechanisms and measures are crucial to maintaining economic stability and promoting economic development. Therefore, the manufacture and issuance of currency needs to be carried out under a strict legal and regulatory framework to ensure the stability of the value of the currency and the safety and reliability of the payment system. This is the end of this program. What do you think about it? Please leave a message to discuss with everyone. Hey, if you like our channel, please subscribe us. Haha, remember to like it.